Accounting is more than just numbers. It's been a long time since we've subsided on the bartering system. Instead of trading one good for another, we trade money for any given good. Money is all around us and is vital to survival. Even though each individual person does not use an accountant, as the number of these transactions increase, whether for a singular person or a business, it instills the importance of financial responsibility. What is accounting? Accounting is the language of business and finance. It's an information system. Accounting is the science of recording and classifying business transactions and events, primarily of a financial character, and the art of making significant summaries, analysis, interpretations of those transactions and events, and communicating the results to persons who must make decisions or form judgment. Put more simply, accounting can be defined as a systematic recording of information which involves analyzing, classifying, summarizing, and interpreting business transactions. Accounting is also considered an art because it requires the use of skills and creative judgment. On top of that, it's considered a science because it is a body of knowledge. However, since the principles and rules are constantly changing, which we'll discuss later, it is not considered an exact science. But what use is accounting to the average person? Why is its practice so important? You may not notice, but the simple things you do and encounter every day can actually be related to some level of accounting. You make budgets, count change, and check the receipts from the supermarket. You may also have listed things you spent your money with at one point in your life. We're also surrounded by business, so who's using accounting? Everyone is. Businesses use accounting information to run the business. Investors use it to make decisions about whether to buy a company's stocks. Creditors use it to make decisions about whether to loan money to a company. IRS use it to determine how much taxes the company must pay, and even customers use the information to determine which company to purchase products or service from. To put it bluntly, where there's business, there's accounting. Just to give an overview, here are some ways that accounting is used within and around businesses. There's internal accounting that is used within the company to provide information for internal decision makers. This is also referred to as managerial accounting and is utilized by management, employees, owners, sales staff, officers, and internal auditors. They use it to know and understand the financial standing of the company that they are a part of. The other type is external accounting, which provides external users with financial statements. This is also referred to as financial accounting. This is utilized by security analysts and investors, creditors and suppliers, government and regulatory authorities, customers, competitors, researchers, and taxing authorities. What is the purpose of the financial statements that these accountants provide, and how important are they? There are four main financial statements. For starters, balance sheet lists assets, liabilities, and stockholders' equity up to a specific date. Then we have income statements, which show the revenue and expense of a company over a period of time. Cash flow statements show the exchange of money between a company and the outside world, also over a period of time. Statement of stockholders' equity shows changes in the interests of the company's shareholders over time. Overall, these statements show the financial performance and condition of the company. With them, we can gather the sales and revenue, debt, total assets, stockholders' equity, among so much else. As discussed in the presentation so far, this information is important for parties on all sides in order to make important financial decisions. Since this information affects so many, it is necessary that certain standards are met when handling others' financial records. It's every accountant's goal to provide fair and accurate reporting of the financial position of a business, but that doesn't mean there aren't ethical issues in accounting. Here's an example of a few. Reporting income, falsifying documents, allowing or taking questionable deductions, illegally evading income taxes, engaging in frauds, and so many more. One of the ways to combat ethical issues in accounting is through GAAP. Since accounting statements or reports are used by various groups such as shareholders, creditors, taxation authorities, investors, public and government, to know about the affairs of the business, it therefore becomes imperative that the statement should be based on certain principles, concepts, and conventions which may be regarded as fundamentals of accounting. Such fundamentals become the common platform for understanding the accounting statements or reports. It increases the acceptability of statements and results in reliable and credible financial statements. Such uniform, scientifically laid down fundamentals are termed as generally accepted accounting principles, otherwise known as GAAP. GAAP is a collection of commonly followed accounting rules and standards for financial reporting. GAAP specifications include definitions of concepts and principles, as well as industry-specific rules. The purpose of GAAP is to ensure that financial reporting is transparent and consistent from one organization to another. Even though this is only required by companies of a certain size, it is a general guideline that most accountants and companies follow. Now that I've shown the size and scope of accounting, let's talk a little more about the basis of all accounting. The whole of accounting is based on a single equation: assets equals liabilities plus stockholders' equity. This is the mathematical expression which shows that the assets and liabilities of a firm are equal. This equation is based on the dual aspect concept, or more commonly known as the double entry system of accounting. This means every transaction has two aspects, a debit and a credit entry. The entry of debits will always equal the entry of credits. It is through this system that one sees the overall effect on the accounting equation. Total claims, those of outsiders and of the proprietors, will always equal the total assets of the company. In a nutshell, the accounting equation above shows us how much of the assets are owned by the owner, the equity, and how much are owed to others, liabilities. It's as simple as that. What exactly are assets, liabilities, and stockholders' equity? Well, let's discuss those in a bit more detail. An asset is officially defined as a resource controlled by the enterprise as a result of past events and from which future economic benefits are expected to flow to the enterprise. To put it more simply, an asset is a possession of a business that will bring the business benefits in the future. It's anything that will add future value to that business. Even employees can be seen as assets. To be considered an asset, three things are required. 1. Does your business own or control it? 2. Will it bring your business benefits in the future? And 3. Can you value it accurately? If these three criteria are met, then you have an asset according to the accounting system. On this statement, you can see some examples of assets listed. Along with those assets, some other examples: furniture, machinery, vehicles, computer, employees, and even stationery. On the other side of this equation, we have liabilities. A liability is officially defined as a present obligation of the enterprise arising from past events, the settlement of which is expected to result in an outflow from the enterprise of resources embodying economic benefits. In other words, a liability is simply a debt of the business. The debt will result in assets, usually cash, leaving the business in the future. A liability requires three things: presents the business with an obligation. Obligation is a result of past events, and settling the obligation will require an outflow of valuable resources. The most common liability is a loan. Another common liability is called creditors, such as suppliers that companies use to purchase their merchandise on credit. The payable accounts listed on the statement in the last slide are representation of credit accounts with other companies. This slide shows an expanded version of the accounting equation. It simply breaks up the stockholders' equity a little more so you can see what it entails. Stockholders' equity is officially defined as the residual interest in the assets of the enterprise after deducting all its liabilities. Put more simply, the owner's equity is simply the owner's share of the assets of the business. It's the assets that he can lay claim to himself. You see, assets can only belong to two types of people. The first type is people outside the business you owe money to, which make up the liabilities. And the second is the owner himself, and that makes up the owner's equity. These three elements, the assets, liability, and stockholders' equity, when compared to one another, not only are they the basis for the financial statements, but they show the financial position of the business. With this information, we decide who to buy from, where to invest our money, and maybe even where to work. Companies use them to decide when to expand, which companies to buy out, and even when to exit the market and shut down production. Pretty powerful statements, I'd say.